Ladies and gentlemen, welcome back to the channel. It appears like we have some bad news for Nvidia. Nvidia shares fall after China opens investigation over possible violation of anti-monopoly laws. The State Administration for Market Regulation opened an investigation into the chipmaker in relation to its acquisition of Mellanox, the Chinese government said. The US, as you know, has blocked Nvidia and other key semiconductor companies from selling their most advanced AI chips to China in an effort to limit the country from strengthening its military. And really in response, Nvidia hasn't been doing a lot of business over in China, so to me, this just doesn't feel like that big of a deal. Definitely not a big enough deal to drive Nvidia 2% lower today. Now, here on the day today, interestingly enough, the S&P 500 is down 0.40%, Nasdaq's down 0.35%. The Russell is massively outperforming both of these indexes by a ratio of 3 to 4 times better. The Russell 2000 is only down 0.13%, and the Dow is down 0.26%. I think this is kind of a little bit of an insight to where people are positioning their portfolios into year end and potentially for 2025. It just looks like the Russell and the Dow are seeing a little bit more optimistic setup into year end. What you can also see is the VIX is up 8% today, and a lot of this price action today, yes, is from Nvidia. Some other big tech names like Netflix are down and Meta is down today. But it has to do with the Syria situation. The pressure on oil this is causing today. Oil is up about 2%, and this does kind of boost worries about inflation. Now, today we've seen a report out that people actually feel pretty good about their financial, prospects. It says here, household finance outlook hits highest since February 2020 following Trump win, a New York Fed survey shows. The median expectation for growth in government debt was 6.2%, down 2.3 percentage points from October and the lowest level since February of 2020. Households expecting their financial situation to be better a year from now jumped to 37.6%, the highest since before the COVID pandemic. This New York Fed survey shows. But what is a little bit more negative is inflation expectations at the 1, 3, and 5-year horizons all increased 0.1 percentage points, rising to 3%, 2.6%, and 2.9% respectively. The Fed targets 2% inflation, but is still expected to lower its benchmark interest rate by a quarter percentage point when it meets next week. And we can see here the Fed rate monitor tool is showing a 90.1% chance of a Fed rate cut December 18th, 2024. Now, keep in mind, we do have CPI in just a couple of days. As long as CPI is not some crazy high number, the Fed's going to be cutting rates. And I think there's actually a greater chance of a surprise downwards CPI number than a surprisingly high CPI number. And a lot of that does have to do with energy cost falling in November. Oil went from about $72 and some change for USO oil down to about $68, $67 a barrel. And that does feed into everything, even core CPI. Oil is an input to virtually every physical company in the world. Also, the share of Americans who said that it is getting harder to get a loan has declined steadily since July, after which bond yields began to fall and the Fed began to cut interest rates. This is from the New York Fed Consumer Survey out today. Fundstrat on X says Trump plans to keep Powell. That equals a near-term positive. November CPI released on Thursday. Syria toppling over weekend barely moves Bitcoin, a proxy for risk assets. We are now in the final 3 weeks of 2024, and we continue to expect equities to finish the year strong, with the S&P 500 reaching 6,300. And honestly, that's probably going to happen, and I'll tell you why. Well, first and foremost, you're probably going to see a year-end chase after we knock out these risk catalysts, okay? The next big risk catalyst is CPI later this week. After that's knocked out, as long as it's in line with expectations, could be slightly higher than expectations. I don't think that's a big deal. Or most specifically, if it comes in lower than expected, you're going to get Wall Street that just feels better because that risk catalyst is no longer there. Okay, that's probably going to be bullish in and of itself. The other risk catalyst is the Fed on December 18th. Now, the Fed's interesting because it's pretty easy to forecast what the Fed's going to do, okay? They're probably not going to give us some kind of big wild card. We don't get a summary of economic projections December 18th. We don't get anything that changes a long-term thesis from the Fed. I doubt the Fed's going to come out and say, yeah, we could raise rates next year, or we're not going to cut rates at all next year. Like, the Fed's not going to box themselves into a corner December 18th. So really, after the CPI report, that's probably going to be the biggest catalyst for our markets throughout the rest of this year, which could likely prompt a chase as everyone is super bullish on economic growth outlooks for next year. And also, I mean, for tax purposes, right? Imagine if you are a hedge fund or institution and you have a lot of tax gains for your clients. Your clients, in other words, are going to have to pay a lot of taxes. But imagine you have a lot of short positions that you're down a lot on. Well, from that perspective, it may make sense to cover on some of those short positions heading into the end of the year. Take that loss on your shorts to offset the gains that your clients are going to have to pay in the stocks that have done well. Okay. So that bit of a short squeeze, if you will, could cause markets to rise pretty exponentially throughout the last couple of weeks in December. And let's also face it, we are not euphoric. We are not that optimistic as far as the actual markets, okay? In fact, in recent weeks, markets have been growing more negative, more skeptical. And you know what they say, right? Bear markets are born on pessimism, they grow on skepticism, and they die on euphoria. We are not at a euphoric moment right now. You may think so, but we're simply not there. This is not a euphoric market like 1999 or 2021. We're just not at those levels of euphoria, not even close. I mean, look at CNN's Fear and Greed Index. You're neutral. You're not even in greed. I mean, 1 week ago, you were at 67, which was on the higher end of greed. You've reset lower quite a bit, and now even today, it's updating again, and we're neutral at 51. You're almost as neutral as you can possibly be. So there is room for markets to become more optimistic into year end. It's not like we're already in extreme greed and it's going to be hard to, get more bullish. No, we have a lot of room to get bullish if people want to get bullish. And right now I see the markets acting differently than, commentators' perspectives, right? Like your major banks are very bullish on next year. Seems like everyone's very bullish on next year, but the markets themselves are not very bullish. So what happens here? Does Wall Street get more negative into year end? Or does the markets just catch up and get more bullish into year end? The markets are probably going to catch up and get more bullish into year end. Nonetheless, CNN's Fear and Greed Index market momentum is extreme greed. Stock price strength is fear. Stock price breadth is fear. Put and call options extreme greed. Market volatility is neutral. Safe haven demand is fear. And junk bond demand currently in fear. You can also see this pretty well shown in the percent of stocks trading above their 50-day moving average. It's up 3% today to 64.43%, but in a euphoric market, something that resembles more euphoria, you tend to get this number above 80+%. Like even the year-end rally that you see in November and December of 2023, where you really had a broad-based everything rally for about a month and a half there. It was getting kind of euphoric as we entered into 2024. Well, you were at 86, 87% of stocks above their 50-day moving average. Like that's a broad majority of the markets trading higher. And we're not there. We're just not even really close. We've been in this range for a while now. And that's part of my argument as of, recently is the markets are not that euphoric until the percent of stocks above their 50-day moving average is upwards of 80%. That's when you want to start saying, okay, maybe things are just a little too optimistic. Now, I want to be clear. I think expectations for 2025 are too optimistic. When the consensus is things are going to be great, odds are they're not going to be as good as we think. Or even if they are really good, it's not going to be as good for stocks because we're already expecting things will be really good. Now, I do think next year we're going to see a lot of broadening. I think you're going to see a broader market-based rally. But hey, that's just my opinion, and that's where I'm positioning as of now. We could see the AI Investor Sentiment Survey November 27th hit a one-year high for bears. That sharply dropped. Bearish investors fell from 38.6% to 30.7%. Neutral investors fell about 3.3 points from 24.3% to 21.0%. And bullish investors skyrocketed the week ending December 4th from 37.1% to 47.3%. So yeah, things do look a little on the optimistic side over on the AI Investor Sentiment Survey, but I don't think that's a huge tell for what's, the actual sentiment in markets today. Now here today in after hours, we do have some pretty big earnings I think you want to be mindful of. C3 AI, Oracle, MongoDB, Toll Brothers, Braze, Vail Resorts, and Casey's that will report earnings. Specifically, Oracle's important for that AI story. It can move software names, data centers. That is one big one we want to watch for. Tomorrow, you have AutoZone, Ollie's, Ferguson, and others that report tomorrow morning. Tuesday and after hours, GameStop, Stitch Fix, Dave & Buster's, Skillsoft, and others. Wednesday pre-market, Macy's. Wednesday and after hours, you have Adobe. And then Thursday and after hours, you have Broadcom, Costco, and Restoration Hardware. So you do have some big names here that can move markets, can move specifically their certain sectors. Now for tomorrow, you really don't have anything for economic data. You do have here the, NFIB Business Optimism Index, and that can be important, but it doesn't tend to move the markets all too much. On Wednesday, though, the day after tomorrow, you have CPI. Expectations are for 0.3% month over month for core, year over year at 3.3%, headline at 0.2% month over month, and year over year expected at 2.7%. All of these three metrics here, core month over month, core year over year, and headline month over month, are expected to be unchanged from last month. It's just your headline year over year that is expected to rise from 2.6% to 2.7%. So as long as we come in line with expectations, we don't have some big upside surprise, then markets are going to be fine. Now, if we see core specifically month over month actually come down, that's where things could look really good for markets into the end of this week. On Thursday, you have PPI month over month and core PPI month over month, as well as initial jobless claims. You are expecting largely unchanged numbers from last month. PPI month over month last month was 0.2%. You're expecting 0.3%. Core PPI month over month last month was 0.3%, expecting 0.2%. And initial jobless claims are expected to come in at 220,000, down from 224,000. So I think after we get CPI, you're probably going to see a risk on move in markets, especially if we don't see much of that risk on activity in markets. I mean, we're certainly not seeing that today. If we don't see that tomorrow either, if markets are kind of just muted, then yeah, that CPI report could set us up for a larger weekend rally. But hey, what do I know? Let me know what you guys think down below in the comments section. I just want to warn you again, yes, if markets do rally into year end, I think that's a good opportunity to take something off the table, to raise some cash, because inevitably I do think we will have a pretty aggressive correction in Q1 2025, as Wall Street is very optimistic for 2025, and we may have to come to terms with things may not be as good as we are expecting. Does that mean a recession? Probably not. But does that mean a super strong economy with no growth scares? Probably not. I think we will have a growth scare in Q1, Q2 of 2025 after the holiday season. You're probably going to see some layoffs pick up. You're probably going to see some actual deflationary pressures, and this could cause, again, some growth concerns. But what do I know? Let me know what you guys think down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.